Today, I'm going to demonstrate a way to improve an already profitable trading strategy that was originally created and documented by Larry Connors and Cesar Alvarez. The modification that I'm going to show you is dead simple, and it triples the net profit, it increases the winning percentage to over 90%, and it reduces the drawdown too. Those of you who are regular viewers to the channel may remember a similar study I did a while ago. However, this time I put a different twist on the exit to get different results. The strategy uses the relative strength index, or RSI indicator, to get signals off of a daily chart, and it works on the S&P 500. This is going to be probably a shorter than normal video for me because the modification is so simple. So I'm going to show you how to get into the trades, then we go over the modification and compare the results. I'm going to show you the test results using the SPX CFD contract supplied by Oanda, and that tracks the Emini future very well. The results you'll see are going to be in points rather than dollars, because the point value for the CFD is actually slightly different to the point value of the E-mini or the micro E-mini. For the main test, we're going to be looking at data from 2008 through to the end of 2019. Then we're going to run some optimizations and make some modifications, and then look at the rest of the data I have, which is from 2020 through to the end of June 2021. Let's look at the rules. As I've already mentioned, we're looking at the S&P 500 and we're looking at a daily chart. We're going to be using the RSI indicator, and we're going to set it to a period of 2. So we're looking at a very short period RSI. The general idea of the strategy is we're looking at an overall uptrend. So it's a long only strategy. We're only looking for buy trades, and we're only looking for buys when the closing price or the closing daily price of the S&P is above its 200 period moving average. You can use a simple moving average or an exponential. It doesn't make much difference. In my test, I just happen to be using a simple moving average. Once we've seen that the closing price is above that 200 period moving average, we're assuming that we're in an overall uptrend, an overall bull market. And then we're looking at very short-term drops in price or pullbacks, and we want to buy those pullbacks or buy those dips and then wait for prices to then turn around and begin to rally again, and then we take our profit into those rallies. And we use the RSI indicator to identify those short-term pullbacks. We use our 2-period RSI, and we look for the RSI to cross down below the 10 level. We can set these levels on our charts. I think the standard is usually 30, but we're going to use a lower level of 10. So when it crosses below 10, then we buy on the next open. Larry Connors does talk about using a level of 5 rather than 10. However, with 5, you are going to get less trades. So for this test, I'm going to use 10. Larry Connors also doesn't document a stop loss. He's discovered that in this sort of a mean reversion type strategy, that stop losses do just hurt the performance. However, I like to trade with a stop loss. I'm sure you like to trade with a stop loss. So I've actually done a quick test and worked out that a 200 point stop loss works quite well. 200 is quite large, but we want to give the prices room to continue to go down ever so slightly before they go back up. So 200 is quite a nice area, so that's what we're using for this study. Larry Connors also suggests a few different exits, and they all work. Some of the exits that he suggests is putting a 5-period moving average on the price and exiting when the daily price closes above that 5-period moving average. A 10-period works as well, and he also suggests one using the RSI indicator. So for this study, I'm going to use the RSI indicator, and our exit, what we're going to compare to is exiting when value of the RSI closes above the 70 level. Okay, so 10 is our entry, and then 70 is going to be our exit level, or that's going to be what we're comparing it to. I'm going to introduce a slightly different exit, but for the baseline, that's our comparison using that 70 level. Because as with using a level of 10 or 5 for the entry, the exit, there is no perfect one. Some work better in some cases, some work better in other cases. And that's the baseline strategy that I'm going to compare it to. When I do the modification, I'm going to keep the entry identical. I'm just going to modify the exit, and for that I'm going to use a method that I picked up from Larry Williams, which I've used quite a lot on this channel, which is his bailout exit, or first profitable close. And what that means is we look at the closing price of each day, and if we're in profit, we get out and take the profit. If we're not in profit, we leave the trade open and it'll either hit the stop loss or we will take the profit. So let's go over to the computer and have a look how the modification to the exit works or improves over this baseline one that we're going to compare to. In this first workspace, I've got two charts, and the top chart, or the top pane, uses the strategy that uses the RSI for the exit. So whenever the RSI crosses over 70, we exit, and the bottom one down here, it uses the first profitable close, looking at the closing price of every bar. If we're in profit, we just exit the trade. And you'll notice that in the bottom we have got a few more trades because we're exiting a little bit quicker. So the entry, in fact, let me just put the RSI so you can see what the entry is. We use the 2-period RSI, and we're looking at an oversold level of 10, and we leave the overbought level, which is our exit, as 70. So we can see every time, so this green line here, this bottom line, is the 10 level. So the minute the RSI comes below 10, we've got a buy, and then we're not exiting until it goes above 70 here, and we're exiting on the next bar. So again, below 10, didn't get above 70, so we stayed in the trade, went below 10 again, but we stayed in the original trade, exited above 70. So that's the original one. And on the bottom one, it's just exiting, first profitable close. So let's have a look at the results. The first one, there's the equity curve, and it's not bad. Again, data from 2008 through to the end of 2019. Recently has dropped off a little bit. Make a net profit of 731 points. 76 trades, we've got a percent profitable or win rate of just over 81%, an average trade of 9.6 points per trade. So let's compare that to the first profitable close. Firstly, here's the equity curve, similar, probably not quite as good. Making less net profit at only 588 points this time. A few more trades at 79. The winning percentage is higher. The average trade is slightly lower at only 7.4 points per trade. Notice we got our largest losing trade of 200. That's our 200-point stop loss. So that's the comparison between the baseline using the RSI exit and the first profitable close before I make any modifications. In the previous video I made, which was using a similar exit using the first profitable close, what I looked at was the amount of points we were in profit before exiting. At the moment in this study we're looking, are we in profit or not in profit? So even if at the end of the day we're 2 points in profit, we exit the trade. In the previous video I looked to see if there was a better number than just 1.2 points, etc. I just done an optimization and I found that 30 worked quite well. So we were looking for a minimum of 30 points. Now in this video, in this study, what we're going to look at next is leaving the points in profit at anything above 0, so it could be just 1 point in profit. However, I'm going to introduce a delay on that exit. So what I'm going to say is I want to be in the trade for a minimum amount of time before we employ that exit. So it might be the case that we want to enter the trade, we want to be in the trade at least 3 days, and then only after that 3rd day we look at each end of day, are we in profit? If we're in profit, could be a couple of points, could be 30 points, we take the profit and run. But we're using that day delay. That's what we're going to look at next. We're going to look at an optimization to see if the day delay improves the results, and I'm sure it will. So in this workspace, we're looking at the day delay, and I'll show you the optimization report. And you see I've created this input called day delay. 1 is no delay whatsoever. You'll remember our 588 points profit at 79 trades. And I've looked at right the way through to 20 days. I don't want to be in the trade much more than 20 days. This is a short-term trading strategy. Now, looking down the net profit and the average trade value, we can quite quickly see that there's some decent numbers, pretty best numbers around here, around about 12 days in the trade. It's the best net profit and one of the highest, if not the highest, yes, it is the highest average trade value. And we've still got a really high percent profitable as well. We've kept over 91% profitable, which is good. So the rules would be enter the trade, wait 12 days, and then start looking every day, are we in profit? If we are in profit, we exit. If we're not in profit, we stay in the trade. And we've got an increased net profit, an increased average trade, very slightly increased profitability or win rate. And let's have a look at the drawdown. Drawdown minus 270 points compared to minus 327 using no delay at all. So it looks better all round in my opinion. So let's use that one and look at the equity curve. So that's the equity curve, which I think you'll agree is better. Recently we are making new highs, so that's good. We've already seen the net profit over 2,100 points now. So that's over triple the amount of our baseline study using the RSI 70 as the exit. If you remember, the RSI exit only made 731 points, so that's really good. Our max drawdown for this strategy is 270 points, and the max drawdown for the RSI exit was 281 points, so slightly less drawdown using this exit too. Looking at the total trade analysis, we have got less trades. The RSI exit had 76 trades. Now we've only got 60 with this because we're staying in the trade longer, giving us a higher chance of making bigger profit. Percent profitable we've already seen, just over 91%. The RSI exit was only 81.5%. The average trade here is huge at 35.7 points compared to using the RSI exit of only 9.6 points. And the largest losing trade on both of them is 200 because that's our 200 point stop loss. So I think you'll agree that we've got improvements all around using this exit. The last thing we do in this pane, we've got both the strategies. We've got the top one, which is using the 70 level of the RSI, and the bottom one, which is using the first profitable close with the 12-day delay. And I want to look at the results from 2020 through to the end of June 2021. Let's first look at the equity curves of both. So one, we're using the RSI exit. I've actually included the whole data, but I've just added on the extra unseen data. And the equity curve is not great within the last few years, unfortunately. Let's compare that to using the first profitable close with the day delay. And we're actually making new highs. The equity curve is still a little bit choppy like the other one, but we are making new highs. You can see here, making new highs. Let's look at the periodic analysis, and that will show us how much profit each strategy has made. So we've got 2021, so we've only got 6 months of 2021 so far, and all of 2020. So remember, we're looking at the strategy now using the first profitable close with the day delay. So we made 303.8 in 2021. We lost 137.7 in 2020 for a grand total of about 166 points. Let's have a look at the RSI exit. And 2021 we made 165, lost 117 for a grand total of only 48 points. So in the out of sample data, the exit using the first profitable close and the 12-day delay did work better. Well, I told you today's video was going to be a slightly shorter one. In this demonstration, what I've shown is that the entry and the exit rules of a certain strategy don't have to be set in stone. As long as we're using the main idea, and the main idea in this strategy being we're looking for an overall uptrend or a longer term uptrend, and we're looking at a way to identify very short-term pullbacks, buying into those pullbacks and then exiting into strength or once we're in profit. And I've demonstrated that different exit ideas do work. And I've also demonstrated that the longer we're in a trade, the more chance we have of catching a bigger move and getting a more quality trade. That's why using the 12-day delay works really well. If you're already trading this strategy of Larry Connors, then you might want to consider using this version too. Something I often do when I get a strategy and two different exits do work, then sometimes I'll split my positions into half. Let's say you're trading 10 contracts. Trade 5 contracts using your original or your preferred exit technique, and trade the other 5 contracts using the different technique like this one. And that's quite a good way to work things. It's quite a good way of diversifying the two strategies within the same strategy. So I hope you've enjoyed this video. If you have, please give it a thumbs up. And until the next one, this is Jared Goodwin, and thank you.